Every year, billions of dollars move across the global economy as distinct corporate entities are absorbed, merged, and consolidated into massive central hubs. This table tracks some of the largest transactions in recent history, capital commitments that redefine entire industries. Look at the top row. AT&T executing a transaction for Time Warner at $109 billion. The sheer scale of these numbers generates massive market noise. But beneath the press releases and the media coverage, the success of every single megadeal relies on one strict mathematical law. The present value of the newly combined entity, A and B together, must strictly exceed the sum of the present values of the two independent companies. If that condition is met, the difference between the equation's two sides is the economic gain. In corporate finance, this mathematical difference is what is actually meant by the term synergy. Firms frequently cite strategic motives to justify these transactions, capturing a new geographic market, securing proprietary technology, or streamlining logistics. Those narratives are meaningless unless they translate directly into a measurable financial advantage, satisfying this equation. To see how this works in practice, we'll calculate raw economic gain from the ground up, evaluate how the choice of financing shifts the risk of the deal, and expose the financial engineering tricks managers use to manufacture fake corporate growth. Corporate consolidation is a mathematically testable event of value creation, requiring evidence that goes beyond the rhetoric of empire building. Economies of scale and complementary resources look perfect on a spreadsheet. In practice, operational execution is highly vulnerable to systemic collapse. This report details Japan's Mizuho Bank, a cautionary tale of theoretical synergy destroyed by operational reality. The three merging banks each used a different computer supplier. Attempting to connect them caused glitches that debited 60,000 accounts twice, leaving millions of bills unpaid. Projected benefits evaporated. If we assume a merger avoids those pitfalls and is executed correctly, we face a specific analytical challenge. How do financial analysts accurately calculate the resulting economic gain? This data table models Cislunar Foods acquiring TargetCo. Analysts project two precise synergies from combining operations, a revenue increase of $2 million and an operating cost reduction of $2 million. These dual synergies yield a net increase in total earnings of $4 million. That $4 million is an annual figure. To find the total economic gain, we have to look at the capitalized value of this new cash flow over time. Applying a strict 20% cost of capital to the $4 million earnings increase reveals the underlying value, $20 million. This $20 million economic gain represents the absolute mathematical ceiling. It is the maximum premium Cislunar can pay to acquire TargetCo before the deal begins to destroy value for its own shareholders. Now that we have verified the existence of $20 million in newly created value, we have to examine how the mechanism of the purchase dictates who gets to keep it. Let's examine the first scenario, a cash purchase. Cislunar pays $47.5 million to buy out TargetCo. Since TargetCo's standalone value was $40 million, its shareholders get a guaranteed $7.5 million premium. Cislunar captures the remaining $12.5 million economic gain. The core strategic rule of cash financing is that the cost of the merger is absolutely fixed. Cislunar takes 100% of the integration risk. If the $20 million synergy fails to materialize, Cislunar absorbs the total loss, but they keep the majority of the upside. In the second scenario, financing through an exchange of shares, Cislunar issues 0.833 million new shares to TargetCo. This recalculates the post-merger share price to $49.85. This drastically alters wealth distribution. TargetCo's gain collapses to $1.5 million, while Cislunar captures $18.5 million. By accepting stock, TargetCo's shareholders are no longer cashing out and walking away. They are becoming part owners of the new combined entity. The core strategic rule of stock financing is that the cost of the merger becomes variable. The value of the payment depends entirely on whether the combined company actually achieves its projected synergies and maintains that $49.85 share price. Cash protects the target while giving the acquirer massive leverage. Stock forcibly aligns both parties, making them share the risk of a disastrous integration. Not all acquisitions are driven by operational efficiency. Many are driven by management ambition and the constant pressure to manufacture continuous financial growth. This leads to the bootstrap game, a Wall Street tactic for creating the illusion of financial success without doing any real operational work. This table demonstrates a purely engineered scenario involving two companies, World Enterprises and a target firm, Muck & Slurry. The setup relies on an exploitable metric. World Enterprises enjoys a high price-to-earnings ratio of 20, while the target languishes at a low PE of 10. World Enterprises leverages its highly valued stock to acquire the cheaper firm through a share exchange. Look at the immediate result on paper. After the acquisition, World Enterprises' earnings per share skyrockets from $2 to $2.67. This artificially inflated EPS creates the visual profile of a hyper-growth stock. It frequently fools retail investors and analysts into buying in. We can deconstruct the illusion by shifting focus to the only metric that truly matters, total market value. It sits exactly at $6 million, the simple addition of the two independent companies. Absolutely no economic gain was created. The combined pie didn't grow a single inch. The EPS only increased due to the mismatched price-to-earnings ratios during the share swap. It is irrational for the market to pay a premium for this kind of artificial growth. Investors can achieve this exact level of diversification themselves by buying shares in both independent companies without paying millions in M&A advisory fees. As the Cislunar and Mizuho cases proved, without hard, verifiable changes to operations, supply chains, or scale, an acquisition is just accounting theater. Analyzing these transactions requires looking past the illusion of EPS inflation, verifying actual capitalized cash flow, and ensuring the financing structure legitimately rewards those assuming the risk.